Hello, everybody, and welcome to the Down to Finance podcast by Future Finance Group in Australia. My name is Amy Tennant, and I'm the Director and Mortgage Broker, and today we are welcomed with Sarah and Mandy.
Hello.
Hi. So today we're going to talk about breaking down the most common questions I get to do with what is the current interest rate, why is everybody talking about fixed versus variable, how do banks actually decide what interest rate is applicable to you, and if you're looking to buy, refinance, or just want to understand what's happening with rates right now, this is the episode to make you feel confident.
So I guess let's start with what is an interest rate, or what makes up an interest rate?
Yeah, of course. So it's a cost of borrowing money from the lender. It's shown as a percentage per year. Your monthly repayment equals interest plus a very small portion of principal if you are paying the bare minimum. Okay. You'll also see a comparison rate with marketing that's done from lenders, which is a true reflection of all fees, charges that are basically bundled together. Sometimes a comparison rate isn't applicable for some client scenarios, like it's there, but obviously a comparison rate is taken over the full term of the loan.
30 years, yeah.
And in today's day and age, we would probably see a duration of most mortgages somewhat with that particular lender, with that particular loan agreement, maybe 4 to 5 years.
Yeah,
for sure. Which is why we say that. Rates move up and down, obviously based on the Reserve Bank, so the RBA cash rate, and then obviously the lender funding costs. Okay?
Yeah, very good. And I guess as well, the current rate environment at the moment, I feel like it's everywhere. Obviously because we've gone up over the last sort of 18 months, 2 years. And
yeah,
now,
it's very front of mind.
Absolutely, yes. Yeah. That's perfect way of describing it, actually. That was what I was trying to say.
I mean, you only have to be driving to pick up your Maccas.
Everywhere.
And it's in bus stops, it's on the radio, it's on the TV ads. I mean, even my daughter, when she's watching Coco Melon, some of the ads are from home loan lenders.
Yeah,
so
absolutely.
It's definitely out there for all to see.
Yeah. And I feel it's the conversations at the moment, they're everywhere, whether it's at, a barbecue you're attending, everyone's talking about it. So I guess as of October, the RBA have kept the cash rate on hold, which, obviously doesn't mean a decrease in the rates, but it's a sure sign of the environment that we're in at the moment as well.
And I think obviously after seeing several rate rises in 22 to 23 and then starting to see some stabilisation in 24 and thankfully starting to see rate cuts in 25 trending right through to next year as well.
Yeah, the rate cuts have definitely helped a lot of people increase their borrowing capacity and buy those homes that they couldn't afford.
And their monthly outgoings as well. I mean,
those that already have mortgages.
Yeah. So their repayments have decreased as well. So obviously once the RBA decide what they're doing, whether it's decreasing or holding it, then, then that's when the lenders come in and decide how much of that they're passing on. So I think that's one thing a few months ago was talking to someone and they didn't understand that not all lenders necessarily pass the full amount on as well.
We've been lucky that most of them have.
Yes, they have this time.
Cuts, but that's not always the case.
Correct.
Especially going forward if there are future rate cuts.
And especially depending on what lender you are with as well. So obviously some self-employed clients or credit impaired clients that might be with those alternative lenders like your Bluestone, Liberty and Latrobe, they have different financial stakes, which means that obviously the way they determine whether they're passing on a rate cut or a rate rise is going to be very different to obviously your main tier and second tier lenders.
So it might not all be at the same time as some of the other lenders passing them on.
Yeah. Correct.
Not as quick.
And there's always a bit of a delay as well. So for example, if the RBA meet, early October and they do decide to do a rate decrease, that might not come into effect with your particular lender until the end of October.
Yeah.
So you won't see that reflection for a little while. So some people assume that as soon as the rate cut happens that their mortgage
an
is going to
immediate-
drop. Yeah.
Yeah. And whilst obviously it's great, I think just reaching out to confirm exactly when that's going to come into effect, and whether that is going to be effective automatically or whether you have to
manually change your repayment minimum.
correct.
Yes.
You may need to actually make a phone call. Or in most cases, if you are with a major lender or
jump on your
second tier
app.
lender, you can jump on your app and do it through that now. So I think obviously just sticking to the products that are available. So might get Sez to touch on what a variable rate is.
Yeah. So a variable rate is obviously, like the term says, variable. So it can go up or down with, the market or the environment that we're in. So it generally has more features depending on what sort of package and things that you go with, but you generally will have an offset and redraw account attached to it, which is obviously an interest saving feature. You can also make extra repayments as well. So
Without
any
penalties.
penalties. Yeah. So that will then shorten your loan term. Obviously the aim of the game is to try and pay off your mortgage as soon as you can. And that's why, some of my clients that I've spoken to in coming back to that minimum repayment and having to change it, a lot of them have opted not to. If you can afford to, because they're like, we're used to it now, even though the shock factor, 18 months ago was awful for a lot of people. Or slowly over the last 18 months, it's became, quite eye-watering to see how much their repayments have gone up by. But yeah, now that they've sort of, worked out their budgeting and things like that, they have stayed and they are still making that $150 or whatever it might be that they've saved. They're still making those repayments. And one I worked out the other day, it meant it shaved like 8 years off their loan term for them.
Yeah, because it compounds. It can add up to quite a bit.
And he was like, oh, wow. Yeah, well, I'm definitely just going to, keep it where it is because I can do that. So, that's, I guess, the point of a variable loan is just the flexibility as well that it can give our clients is a real bonus.
And it's like as simple as if you're paying extra, you're paying more off the principal.
Correct.
You're paying less interest to the lender, and ultimately that's what's forcing the term of the loan to go down. So in most cases, clients that would opt for variable type loans are generally people that do have a good budget in place.
Yes.
That do have surplus income available, and potentially in employment industries where they might receive a bonus or commission.
Yeah,
or,
like bigger lump sum, money that's coming through
have a variable
account.
income. They've got that flexibility there. So, I think variable loans are definitely a great option for some clients. But on the flip side, Mandy, we also have the other alternative,
which is fixed rate loans. Fixed rate loans are way more structured than a variable. So you're locked into a fixed rate for an X amount of time, whether it's, 12 months, 2 years, whatever that might be, which is what's nominated at the time of taking the loan out. With fixed rates, there are restrictions around how much additional repayments that you can make. So with that variable, you can make as many as you want. It's no penalty. Whereas with fixed rates, there might be a cap on how much you can make on a monthly or an annual basis. And then there's also...
And I think that's really important in the environment that we're in right now where we're seeing interest rates decrease. You don't want to get caught up on fixing in and then thinking that you can put 50K into a low fixed rate if you can't, and then you're penalised.
Yeah, and with fixed rates as well, if the RBA do decrease the interest rates and your lender is passing it on for variable, they won't pass it on for fixed rates.
Correct.
It will stay the same. So that means that depending on the environment, you might actually end up having a higher fixed rate than what the variable rate will be over time. So it's really important to plan ahead and making sure that you are picking the right amount of time to fix that rate for.
Yep. So there's like limited extra repayments, but also you need to be aware of break costs if you exit out of that fixed term earlier than the agreement.
Yeah, absolutely. If you've fixed it for 2 years and you're wanting to exit out at 1 year, then there will be costs involved with that.
Yeah. And sometimes like life is, unforeseeable. You don't know what's around the corner. So ultimately, if you've locked in for 3 years and then, you have a breakdown of relationship or you outgrow your house and you need to sell and rebuy or,
Circumstances change.
You want to refinance, pull equity out, buy an investment property. There's so many options. So I think when you're taking on a fixed rate, you really need to think about that long-term
plan ahead.
ahead. Yeah.
Have
Okay.
that strategy.
And I think as well, just to add to that, like it's not necessarily a bad thing to fix your rate as long as it suits you. But I think even especially probably I'm going to use first home buyers as an example. A 1 year fixed rate is sometimes a really good thing just for them to get settled into a mortgage, like being
comfort zone.
Yeah, and knowing that, every month their repayment is X amount and they know non-negotiable, that's what I'm paying sort of thing.
Yeah.
But they're all things that we would discuss in our appointments.
Yeah, a different like target market of client for both variable and fixed. But I think one of the perfect target market clients for a fixed rate is definitely first home buyers, single parents out there that ultimately have children with one income coming in.
Or even parents that have just maybe grown their family, like by, having their first child or, knowing that maybe the wife is going to be on maternity leave, So I think, fixed rates definitely have their place.
For sure.
But it's, again, about understanding what your goals and objectives are.
And sometimes they can be like so attractive that the offer's too good to be true.
Yeah.
Like
so
I
much
think
lower.
we've got fixed rates at the moment starting with a 4.
Just sitting under that 5%.
Watch this space. Because obviously over the next few months we'll probably see some even more hot fixed rates out there as well.
Which would probably bring us into like split loans as well and understanding that structure where, you might opt to have 2 splits and part fixed and part variable. So whether that's, 50-50 down the middle or, if it's a $500,000 loan, you might fix in 400 and keep 100 grand in variable. So you're getting the best of both worlds.
Yeah, absolutely. So just to highlight, you don't have to have 100% of your mortgage on either variable or fixed. There definitely is the combination option available for you where you can get the best of both worlds. So that 100,000
can have your offset linked. For those people that might have maybe 50K sitting in their offset account, then we can offset that 100K split. The fixed is obviously going to give you the certainty. So generally speaking, for some of my clients, I might do maybe an 80-20 split rule and, keep 20% variable and 80 fixed, depending on the circumstances.
And that becomes their principal goal to try and pay
that 20% down as soon as possible. If they, get a good tax return, that's where we're going to be pumping in all the money doing extra shifts or whatnot, then that's
we can customize the loan to the client's needs. And their circumstances.
Absolutely. And I think obviously it's just process of elimination, like going through option 1, we can go 100% variable. Option 2 is 100% fixed. And then option 3 is some form of combination loan. And this is what it would look like. And whether or not that is going to be the best option for the client. So I think obviously, presenting all 3 options is a really good thing because then you can take your time, digest and work out what's going to be best for, not just now, but obviously in the coming future years as well.
Correct.
Another thing that can determine obviously the interest rate that you're repaying back to the bank is obviously what product type. So there are basic loans, which I would refer to as like no frill loans. And then you've got your professional package type loans. Now, ultimately, most of your major and second and third tier lenders will offer some form of basic to pro pack. And then obviously as you start to move into the alternative lenders, like your non-bank lenders, there's going to be less of that option available. So let's just focus on the basic option for now says. What does that look like?
So definitely lower fees or no fees in terms of like establishing the loan and things like that. You know, you'll only just be paying the small, very small fees, like maybe a settlement fee, etc. But it does, however, come with fewer features. So generally speaking, for most of the main tier lenders, if it's a basic product, you know, you're not getting an offset account. You know, you will get redraw normally.
You'll get like online redraw.
Yeah, so it can be a little bit clunkier in terms of
there might be a minimum amount that you can redraw. So like rather than just redrawing out $50,
yeah,
you would $500
exactly. So that's not to say that the basic products are not good. It really just comes down to, I guess, someone's scenario and what is best suited to them. So
there are situations where a basic product is the best option for the client.
Like, you know, if there's not a lot of money transacting.
And the loan size can also be really important.
Actually,
because obviously you don't want to be, you know, putting a $250,000 loan on a pro pack if it's really not going to be financially feasible for that client.
Correct.
So I think there's a number of different options that can come into play when offering a basic home loan. But as you said, like it can have a lot of pros for that particular client as well.
Yeah. So if you just want to, simple, no frills. Basic home loan with really low fees, basic is definitely a good option. Yeah.
And then you've got the professional package. So, Mandy, what does that look like?
Professional package is what gives you more flexibility, which is what Sez was saying before. You can have those offset accounts. You can then put extra funds in there if you're getting commission or bonuses or anything like that. And any funds that are sitting in that offset account can then be reducing the interest on the loan. With a professional package, you usually do get a discounted interest rate. So that gives us more flexibility to then negotiate with the lender on your behalf to get that lower
and that
rate.
Discount is off the standard variable rate for the life of the loan.
Correct. Yeah. So it's not just a 1 year or a 2 year, it's for the life of that loan.
It's not like a honeymoon rate or anything like that.
Exactly. So that difference in the interest rate can be a huge amount that the person is paying on their repayments as well. So offset accounts, some lenders, they have one offset account available. Some of them you can have up to 99. So it's really depending on how you want to structure your banking. Some people might want to have like a holiday fund and then a shoe fund and then they might want to have, a bank account for each of their kids, and all of the money sitting in those accounts can then be reducing the interest on the loan.
Yeah, fantastic. And I think with a professional package as well, you can sometimes tie other features in like credit card and everything like that, where some people opt to, I guess, live on an interest-free credit card for 55 days and build up their reward points and things like that, and then have the bulk of their income sitting in their combined offset account. So it's, reducing the interest and ultimately paying off the principal. Obviously, we highly recommend that particular product is paying off that credit card after those interest-free days though, because the day that you start paying interest on the credit card defeats the whole purpose.
It'll be very high
of the product. So people that generally would go on a professional package are people with investment properties, people that normally have loan amounts above 500,000 and maybe income over 150,000. That's a bit of a sort of, snapshot of what the target market of client would be to go on a professional package. But definitely there's two sets of rates, generally speaking, for a basic and a pro pack, and that's obviously why. Trending right now, I would probably say that many first home buyers would be leaning towards, a basic, variable, just to watch what the market is doing, I guess. And then most refinancers, what would you say? Like, I think refinancing clients with an investment property right now is probably
definitely a package client.
Package, and definitely looking at some fixed interest rates for investors.
Doing that split combination.
split combination loan.
Yeah.
So I think obviously, yeah, again, having that really important conversation at the start to work out what you truly are looking for. But again, the best part about it is there's multiple options available for you. And that's what's so exciting about what we do and why we love what we do, I guess, because it's like a needle in a haystack, trying to obviously find out what the right thing is and then being able to present that to you so that you're really happy with the ongoing product for years to come. What determines your interest rates? Because there's obviously
Lots
now
of things.
when we get asked that question, there's probably 50 sellers that way, 50 sellers that way. Back in the day when I first started, 12, 15 odd years ago, there was probably one rate chart and maybe there was a interest only option and a principal and interest only option.
Definitely became more complex these days.
What are some of the contributing factors, would you say?
So definitely what product type you're on. So back to that, whether we're putting you on the professional package or basic. Generally speaking, the basic package they sometimes sit around the same sort of rates, but obviously the fees and things like that. And probably a big one is the loan to value ratio of your home.
Sure.
So if you're sitting under, there's lots of banks out there that will actually do tiered pricing. So, if you're sitting under a 60% LVR, obviously that rate will be sharper. Then there's say 60 to 70, that would have, be slightly higher, 70 to 80. And then once we creep over that 80%, then that's when they start to...
Once we start getting into LMI territory, the rates start to go a little bit higher, start to have a little bit of a rate loading. So the just so our audience understand, the more equity that you have in your property, the better the rate, the lower the risk you are to that lender.
Yeah, so they tend to reward those clients with a sharper rate.
And the benefit at the moment for first home buyers, I guess, is on the 95% first home loan deposit scheme. All of the lenders, generally speaking, are giving a discounted rate.
As if you're an 80% purchase.
As if you already have that 20% equity available in your property. So that's really, really good for you guys. Mandy, anything else you want to sort of contribute to the factors of how a rate is determined?
Credit report is also a real big one. The client's credit score and where they sit on that. If they've got, a bad credit score, then we might need to look at taking them to a lender that does have that higher interest rate, or looking at an option that does have a higher interest rate as a byproduct of that, because they might not necessarily be eligible for a main tier lender. So that is a big one that can kind of determine that. We've also got the repayment type as well. So whether you're looking at principal and interest versus interest only loans. So
yes, that's a great one. Yeah,
that can really determine it. When you're going for an interest only loan, your interest rate is generally higher.
Yes.
Or if it's an investment loan over an owner occupied loan, they can generally higher as well, just because it's a lender risk appetite. So they charge a higher interest rate for that higher risk.
So there's different variables.
Another one is your fixed versus variable. So fixed rates tend to be sharper. They might be that slightly lower, but like we mentioned before, you're obviously locking in for that period of time. So,
And I think, at the end of the day, the lender appetite is really important. Lenders can change their interest rates around to either stop the flow of applications coming in or increase the applications that are coming in. So, we see it all the time. Sometimes pricing can be amazing with one lender for 60 days and then all of a sudden they just turn the tap off and you do pricing and it comes back really poor. Then, you have to research somewhere else. So I think, just in terms of lenders, the best part of working with a mortgage broker is that, we don't just have access to one funding line that's just going to spit out one rate. We are able to do the background research in terms of doing pricing with 5 or 6 different lenders and then coming back to you and delivering that outcome.
And they're always changing. They always have, like, each lender would have their spot in the spotlight, I guess. So you might have one lender that's really, really good for a few months, like you mentioned, and then they'll go out of the spotlight and we're like, okay, well, they're not giving us really great pricing. So let's look at another lender that they're really, really good, but 6 months ago they weren't. So it's constantly changing.
Yeah, absolutely. And they'll always run specials, like every industry. Like they're always going to do like different specials for different clients and so forth. So it's really important that, like obviously the information that we're giving to you right now is valid for right now. And then in 3 months from now,
it could completely different.
Totally change. So obviously when we meet with a client and we're setting up your action plan and you're not ready to buy for 6 or 12 months, we're always going to come back and revisit that scenario to give you the most true and accurate information. I guess just in terms of some quick tips for our listeners, just to run through some things, what would you say as one of the most important tips for our listeners, Says?
One thing that I probably would say to my clients a lot is, I mean, obviously we all want to have the lowest rate possible, but not necessarily to be hyper-focused on the rate and, you know, the fact that your best friend might have 5.29 but you're on 5.35. Like the product, I guess we need to look at it as the
bigger
whole picture.
Yeah.
You know, that the product, you know, what features that loan has and things like that. They're all things that you need to consider for the lifetime of your loan or, you know, even for the next 5 years. So,
and I think it's easy to say, oh, I'm like a 2-adult family with 3 kids. I match my best friend. They're a 2-adult family with 3 kids. But behind the scenes, from a home loan perspective, like you could be running 2 completely different households. Like
one might need multiple offsets. One might only need 1 or no offsets, and that is a very different product right there.
So I think like, that barbecue talk that you could possibly get into over weekends and stuff like that, you know, it's still really good to have those conversations. But at the end of the day, like then referring back to an expert just to make sure that that is the right information at the end of the day.
Yeah, absolutely.
And Mandy?
Consider your cash flow as well, I think is really important, because that can really determine what sort of product that you go on. Are you expecting a pay increase or something? If things might be a little bit tight, maybe you want to focus on a fixed rate for a little while because you know the next 6 to 12 months might be really challenging and you want to know what your mortgage repayments are going to be every single month.
Absolutely.
If you're expecting, you know, a large sum of money coming in, like selling a caravan or a boat or something like that, okay, well then we might want to look at getting you an offset account that we know the money's going to be sitting there. So forward planning, knowing your cash flow, knowing what your budget can afford as well.
Yeah. And I think, just weighing up the pros and cons of every option that we sort of give to you is really important, and then going from there. I guess in closing, we just want to say that understanding how interest rates work and what products suit your lifestyle can save you literally thousands of dollars. I mean, I've seen clients that have, you know, earned, you know, $300,000 a year, had $100,000 in disposable income. Their mortgage might be with Bank of Melbourne. Their income's getting paid into, you know, Suncorp, and their savings is with Macquarie. And they've got 3 banks all working on their behalf, but none of them are really benefiting them. And after we restructure and reset out their plan, like they're literally saving like thousands per month. So I think rather than, you know, thinking you can do it on your own, like we obviously are a massive value add to you being able to save thousands of dollars. So just reach out, visit the Future Finance Group website, contact us through our reception team, and we'd be more than happy to obviously provide you with a free, no obligation, you know, comparison. And thank you, Sarah, and thank you, Mandy, for joining us today. And we look forward to chatting on our next podcast. Just remember to keep in mind, these podcasts are just general advice. And if you are after something more customized, reach out to your financial advisor, or you can reach out to us and we'd be more than happy to help.